Reed, welcome to our webinar. How are you doing today?
Doing all right, doing all right. Thanks for having me.
Absolutely. Now, before we dive into all the questions, tell me a little bit about yourself, your background. How did you get into this industry?
Yeah, sure. I always get asked that and get asked about, what's your ties to Hawaii and how did you end up there? I was actually born in Hawaii, but I spent about 15 years in the Carolinas and went to school out there, went to University of South Carolina. And then out of college, I got involved in working for a real estate investment trust in the Carolinas. And that's kind of my first foray into commercial real estate finance, that area. And after that, I got involved in our family company, Myers Capital, which was actually started in 1998 in the Carolinas. And was there for a few years and then ended up wanting to just decided I wanted to move back to Hawaii. So I was able to do that finally. Came back out here and opened up a branch. And basically just kind of grew it from there. I never left Hawaii, put down roots, got married, had some kids. And so Hawaii's been my home for the second time now for the past maybe 15 years or so.
Amazing. I love that because I know before we started this webinar, we were talking about the Hawaiian shirts and what that was all about. So that's beautiful. So Myers Capital is a family-run business. That's what I'm hearing.
Yep. Yep. We're second generation. So my father started the original one. And then I took over once we kind of converted over to Myers Capital Hawaii. And now we used to have branches in the Carolinas and in Virginia. And we as things have evolved with technology, we find we just don't really need it anymore, but we still have a lot of relationships over there. So we do all our lending from Honolulu, Hawaii. So
Oh, that sounds lovely versus gloomy New Jersey right now. So talk to me a little about Myers Investment Group then, because I heard about Myers Capital now. So who is Myers Investment Group?
yeah, Myers Investment Group is basically our investment management company. So it's the side of our business where we actually bring in outside capital investors who want to invest with us, primarily in alternative investments, and then more specifically, it's what we like to call passive mortgage investments. So mortgage lending is our background. We live and breathe it. I've been doing it close to 18 years now. And we found that there's a lot of opportunity from an investment standpoint instead of just being a borrower. And we have a lot of clients that like to obviously borrow money. We help everybody from buying homes to helping them buy their first investment property to embarking on fix and flip careers, small developers, builders, and commercial property owners. So Myers Investment Group is basically set up to help facilitate being able to participate as a mortgage lender in a lot of these deals that we're funding.
Perfect. Now you said passive mortgage investing. What exactly is that?
Yeah, so basically it's, a lot of our viewers have probably borrowed money in the past, they bought homes, they've been on the borrowing side. Passive mortgage investing is just a way to participate as being a lender, basically. And being a lender can have a tremendous amount of perks. There's a lot of advantages to it, but it's a way to participate into getting an income stream from usually it's a promissory note, but it's all secured by real estate. So everything we do is secured by real estate. So it's essentially, it's a mortgage, right? So when you borrow money from a bank and you go get a mortgage on your home, they're going to put a lien on that property. And then you've got to make payments to the bank and the bank will receive that interest. So it's the same thing. It's just you are now participating on the other side of the table where you're basically almost like the bank.
Amazing. And now you just touched on this briefly, but what are the other benefits for investors for getting into more passive mortgage investing? And what about the potential returns?
Sure, sure. Everybody wants to know about the returns. Of course. Yeah. So benefits of passive mortgage investing, it's very steady. There's a lot of steadiness to it. There's stableness to it. Um, it's very consistent. So the kind of the typical investor we would see is somebody who's looking for that a little bit more on the conservative nature, right? Maybe they've explored participating some real estate syndication, things like that. And sometimes those syndications can do very well, right? Sometimes they don't. It can sometimes be make or break. the time frames that you invest in those types of deals too can also be longer. You know, we're looking at commitments between 3 to 10 years sometimes, just depending on the deal. So passive mortgage investing is a little bit different in that right out of the gate, you just simply earn a return because this is a constantly performing income stream. Now, I say the constantly performing side with a caveat because, of course, sometimes borrowers will fall into, challenges with their finances and they may not be able to make payments, and we'll talk about that. But basically, it's an income stream. So that's really good for capital investors who maybe want to invest through their IRA or self-directed IRA, where they're looking for this consistency. Maybe they're even living off this income. So that's a big differentiator between both maybe real estate syndications, other alternative investments, and passive mortgage investing.
Amazing. And what are the potential returns you have seen, if you can give a range?
Yep. So generally we see on average we're, running net annual returns somewhere between 10 to 11%. Sometimes it can get up into the 12s. And this is net returns after basically our management fee. The way we set these up, there's different ways to invest. Some are what's called direct mortgage investments, where you can actually directly lend on a specific deal. And I think if we have time, we'll go through and show a couple of case studies of actual deals that we've lent on. And then there's another way as well, which is through our fund, which we can't really talk about it publicly right here. I can talk about it on the side once I have a suitability calls with investors if they're interested in finding out more. And this is due to just securities laws and regulations.
Regulations, yep. All that red tape, right?
Yeah.
We love that.
Yeah.
So something I always hear is, and I say this myself, alternative investments, high risk, high return. So what are some risks involved with this type of investing in passive mortgage investing?
Sure. Yeah, so just like anything, they always ask, is this guaranteed? Is this? I was like, absolutely not. I mean,
Oh, the word guaranteed.
there's no guarantee in anything in life. Whoever says that it's blowing smoke. And I always want to make sure that whoever is going to be interested in getting involved, that they actually know all those. And it's one of those things that's really important to me. My name's on the door. That's part of why I did it that way. I want people to know who they're investing with, so it's very public about that. And I'm comfortable with it. And I know I have a sense of who this is good for and who it's not. And I don't have a problem telling people that I don't really think this is right for you if it's not. But for the people that do feel like it's right for them, we go through a number of steps of suitability, to make sure that it fits with what they're looking for far as their financial goals. But protection wise, okay, what's worst case scenario? You got to think about it. What we're doing is we're lending somebody money, but it's backed by real estate. So that means there's a lien on a property. Primarily, these are first lien positions. And so what that means is a hard asset. It's just like your banker. You go to the bank, say, I want a loan. The first thing they're going to say is, what's your collateral, right? In this case, the collateral is real estate. And so our average, what's called loan to value, LTV, is typically in our portfolio around 60%. So in Hawaii, where we see a common average single family home, at least on Oahu, is $1 million. That means on average, we're going to be lending this borrower, this investor, maybe $600,000. So you got to think about, in that instance, there's about $400,000 in equity. Equity is your protection. That's your bread and butter. It's the safety net that we have as a lender if something were to, go in default and the borrower not be able to make the payments. We never want to assume that we're going to and hope that we're going to foreclose on a property. This is just a matter of protection to protect our capital investors and protect our money. But the truth of the matter is, yeah, we're first in line for the most part. The property is valued at $1 million. We've lent them 600,000. You're gonna have, if we had to foreclose on a property, you will have things like court costs, attorney's fees, our management fees for managing that foreclosure process, things like that. But that's why we build in such a high equity position, is to protect ourselves, our money, as well as our capital investors' money, in the event that the borrower doesn't make payments. And it can happen. Doesn't happen very often. I think our numbers are like maybe 1 or 2% default rate. So
That's amazing. That's amazing. You guys are going through that extent to ensure that your investors' capital is protected. Now, let's talk a little bit about the current markets. It's been a very interesting time, this environment, right? So, what is your take on the current market conditions, and what do you think? How do you think it affects your investors?
yeah, it was interesting because I just sent our marketing director a link this morning, and it was about how right now currently there's a divergence. So after the election, the 10-year treasury yields went up. 10-year treasury yields are what affect mortgage borrowing costs. At the same time, the Federal Reserve has been dropping their short-term interest rates. So what does that mean for savers? What does that mean for investors? What does that mean for borrowers? It's all different viewpoints on how they're going to be affected. So let's talk about savers. Okay, well, savers are people who are putting money in the bank, maybe money markets, maybe CDs, and they've been paying out pretty nicely, right? In the past couple years. Earning, you're not beating inflation, but you could get, 4, maybe 5%. That's starting to deteriorate as the Federal Reserve is kind of dropping their short-term, interest rate. So you're going to see a lot of these investors, if that continues, you're going to see them starting to think about getting back into the markets or doing something else because the returns are going to be pretty meager.
Mhm.
Um, on the investor side, as far as let's just say more of a little bit more of a sophisticated investor, willing to take on a little bit more risk. As far as their options go, real estate syndication, I can't really speak to that. But as far as passive mortgage investing goes, general rates, mortgage rates that we charge on bridge loans, they don't really deviate too much. We're not as subjective to what's going on in the real estate markets. And I would say on average over the past, I don't know this exactly, but going on 20 years, it's kind of the average bread and butter rate, mortgage rate that a private lender like ourselves can charge for bridge loans start at 12%. And that's kind of the truth of the matter. Um, there might be slight fluctuations here and there, but we're not really affected by kind of the changes in mortgage rates so much that when you're buying a home, you're getting a home loan, how you're going to really fluctuate based on the demand for mortgage-backed securities and things like that, and 10-year treasury yields. So ours is back to that consistency. Passive mortgage investing, at least in our world with bridge lending, it's you know it's pretty consistent. Um, so yeah, that was a long-winded answer.
Oh, good. I love it. Do you have any predictions for the future of your industry with the change in administration and everything
Yeah,
going
I
on in the
mean, I
economy?
think the alternative credit markets in general, I mean, our industry is really growing. I was trying to find that article as I was mentioning, but there are a lot of groups and companies trying to get alternative investing more prominent, more accepted through, I guess, your RIAs and your different investment companies and things like
Mhm.
that. And look at your industry, self-directed IRA companies, that's grown dramatically. As far as our industry goes, we're a small player in a very large market, so we're very much dictated on our specific market. But as long as we're lending prudently, conservatively on real estate, even if there's a fluctuation in values, back to that example, we lend $600,000 on $1 million property. If God forbid there was a 10% real estate drop, which Hawaii doesn't usually see drops like that, or even a 15% drop in real estate, we're still going to be pretty well protected. So it's very, as the market as a whole, yeah, everybody wants, real estate values to be obviously affordable. If you're a buyer, they want appreciation if you're already an owner, right? It's one or the other. But I think the real estate market moving forward, I think there's going to be probably a little bit more inflationary headwinds
Mhm.
than we had thought prior to the election. Now that could be semi short-lived, yet to be seen, with tariffs and things like that. A lot of economists are claiming there's going to be more inflationary pressures. But the interesting thing is going to be what's going to happen if short-term rates keep dropping, and maybe that might stop. But inflationary measures are going up, 10-year yields going up. It's kind of like we've got two different directions. The
Mhm.
economy and the interest rate markets can head. So yeah, it's going to be interesting to see.
That's what I'm hearing is the general consensus. Everyone's very interested to see how 2025 pans out. Thank you for your input on that, because I'm sure a lot of our attendees would like to hear from the experts out there too. Now, before we move on to who can invest and how can you invest in Myers Investment Group, I know you have some case studies, and I'm sure everyone would love to see some of these case studies. And if you can walk us through them, that would be great.
So yeah, so this was a multifamily property that we helped. He's actually a successful real estate broker here in Hawaii. He purchased this property. I think this one was earlier this year. So we helped him acquire the property, closed very quickly on it. The purchase price was about 650. Whenever we get lend on any property, we always get a valuation. So sometimes our loan to value is so low that we'll accept things like a very minimal, very lightweight way to save money and actually quicker, but it's what's called AVMs, automated valuation models. Most of the time, we'll get a full appraisal. So whenever somebody's buying a property, if the purchase price is 650, we're gonna lend on either the purchase price or the appraised value, whichever's less, and that's pretty common. So in this case, we got a full appraisal, property appraised at 650,000. The interesting thing about this was a multifamily property that the borrower just needed a loan for. Really, he was looking for, I think, about 6 months, but we gave him 12 months just to be safe. And remember, keep in mind, these are bridge loans. So the definition of a bridge loan is to get you from one place to the other. It's not a long-term loan. So it's not a 30-year fixed loan. What that means is typically they're structured where the borrower makes monthly interest-only payments. And at the end of the term, in this case, 12 months, the borrower needs to pay off the entire balance. So that's kind of goes back to what I was saying about, these loans are when you invest in passive mortgage investments, this is not like a 10-year hold or anything like that. You can have your money going to work for you for as short as 12 months typically. But most of the time when people get interested and they start to see how this works, they see the returns, they see the consistency, they invest for much longer periods. But it is semi-liquid in that sense. So in this case, yeah, we got the property valued at 650. We lent the borrower 390,000. This kind of case in point. I think we lent basically 60% of the value of the property. And the key way to whether or not one of the key factors of whether or not we're going to do a deal is how the borrower plans to exit. So this is called their exit strategy. So an exit strategy is because we have to know, we have to understand, and we have to get comfortable with how the borrower is going to pay us off and when. So in this case, the borrower is planning to sell. He already had some other piece of properties he was planning to sell, and he could push his sale faster than what was, faster. And that when he sells his property, what that means is maybe he's willing to accept a little bit lower price and he can sell it right away. So in this case, and this is a common exit strategies, our borrower will pay us off once another piece of property sells. And so we look into that. So in this case, that was what he was doing. He's going to sell a piece of property. Once that sells, he's going to pay us off. So it's pretty straightforward. We got really comfortable with it. Our net return to our capital investor on this one was 11.19%. So if they, in this case, an investor took the entire loan, 390,000. So they invested 390,000 in this deal and earned them a monthly income of about $3,600 a month. And we can go ahead to number 2. All right, so this one's a little bit different. So we lend on, our markets that we lend in are primarily Hawaii. And that's our backyard. We understand it. We're most comfortable with it. But we do lend in pockets on what we call the mainland. So Northwest, we stay out of California, a couple states in the Sun Belt, Texas, New Mexico, we like, and kind of the mid-Atlantic throughout the Southeast. And we're kind of being cautious throughout Florida right now, but mostly the mid-Atlantic, Southeast, so maybe Virginia through the Carolinas and Georgia, because of, our experience and our relationships there over the past, couple decades. So this particular deal is, and both of these were Hawaii, obviously. This was a land deal. So Hawaii is one of the only places we lend on land. a lot of Hawaii's real estate, the valuation is in the land. Much, much different than buying a parcel in the desert, Las Vegas. I have
Mhm.
some clients that they said, a lot of people in Hawaii love to go to Vegas. Some of them like to buy or get started in real estate out in Vegas. It's much more cost effective than Hawaii. And I have some clients that own these tiny parcels. Well, they're not tiny, but um, in subdivisions that they bought 20 years ago, and they're worth the same as they bought it and what they paid for 20 years ago. So Hawaii's land market is much, much different. Um, you get it back to that example of $1 million single family home on Oahu. I would say somewhere around 800,000 of that valuation is the land.
Mhm.
A lot of the value, the actual protection is in the land. So with that, we get more comfortable with it. So in this particular case, we had a borrower. He already owned the property. He already owned this residential lot, and it was free and clear. We got the property valued at $2 million, just the land. There's nothing on it. It's in a very exclusive planned urban development subdivision, and he needed about $700,000 to basically put into the property, do some grading, do some of the infrastructure work to get it what we call pad ready, and he was going to sell it after that. So we lent him $700,000 on a $2 million valuation, 12-month term, and we had a couple investors that took this particular deal. I think one of them invested maybe 500,000, the other one invested 200,000, and they are currently earning on this performing loan about 11% a year. So combined, if somebody took the whole $700,000 investment, their monthly income's about $6,400 a month. Yeah, let me know if you have any questions on these, Donna.
Perfect. I'm just observing and just absorbing everything you're saying. I was still thinking about why a lot of Hawaiian people are investing in Vegas. I can't wrap my head around that part, but we'll talk about that later.
Yeah, it's popular.
It's very interesting, especially knowing the value of I think everyone knows the value of land in Hawaii. Like it's really high in demand.
Yeah. Oh yeah. All right. So this is a more of a bread and butter type deal. This one we actually lent on an existing single family home. So Hawaii is highly regulated. So short-term rentals, especially on Oahu, legal short-term rentals are few and far between. Um, most of them are, if you're legally doing it, which right now they've cracked down so hard on short-term rentals that you don't even want to get caught doing it, trying to do it under the table. Um, most of them are legal short-term rentals are going to be in resort areas like Waikiki,
Mhm.
and where a lot of hotel zoning is. Um, on Oahu, it's rare to find legal short-term rentals on single-family homes. This particular neighborhood has that, and the values have shot up dramatically because of that. The income the borrower produces on this unit and other owners in the area are dramatic in relation to the value of the property. A lot of single family home long-term rentals in Hawaii don't make that much sense. They definitely don't make sense putting 20% down. They don't make sense a lot of times putting 30% down. You got to put like 40 or 50% down. When I say makes sense, if you're looking for cash flow. So I'll back up a little bit. Obviously, in this case, we didn't buy this property. We're the lender, but our borrower owns this property. But it's important for us as a lender to understand the real estate and how this real estate property owner is making money. What are his risks? Because his risks can become our risks. And it's really, really important for us to understand that. And I'm a real estate investor myself too. So I look at things like that. Like, what would I do if I were in his shoes? What are my risks, my concerns that he may not be telling me that I need to vet out? I also bring that knowledge as far as renovating properties, which I've done for some of my personal real estate as well. Is this project overblown, right? What kind of experts do we need to get involved here? Are these bids like concerning for the area, for the labor costs, material costs of the area, things like that. But in this particular case, this was a real short-term loan. We lent a little bit high leverage on this one, but we were comfortable with it, given the value, given the borrower's experience, his credit, liquidity, things like that. So we valued the property at about 1.6. We lent him about 1.3, and our net return to a capital investor was 10%. And this resulted in monthly income of about 10,000, almost $11,000 a month. So a very clean deal. He plans to pay it off quickly. Sometimes on these short-term loans, um, maybe shorter than 12 months, we will put clauses in there, which is to basically make, when we do a loan, we want our capital investor, much of your audience and myself, I'm a capital investor inside of our fund, to get a certain return for a certain period of time. Otherwise, it's kind of not worth our time. I mean, it's great to make that return, but if it's only for just a one-shot deal for 30 days, and it's kind of like, well, now I got my money back. I got paid back my principal. Now I got to find another home for it,
Mhm.
right? So on these short-term deals, which we will do occasionally, we like to put in there clauses where there's a guaranteed minimum amount of interest our capital investor will earn. And sometimes that can actually be a windfall for our capital investors. I'll kind of explain. Um, if For example, there was 6 months of guaranteed interest. And let's just say the monthly payments were $10,000 a month in interest. So that's $60,000 in guaranteed interest. Well, if the real estate, the property owner ended up, maybe it was a flip. So he's selling the property. He got a good offer. He wanted to move on to the next one, and he sold the property in month 4 instead of month 6. Now we're our capital investor and Myers Investment Group as the management company of that loan. Um, we're going to earn still 6 months of interest, but the borrower only kept the loan for 4 months. So that's 2 extra months of interest that I mean, I could do the math, but I don't want to waste your time running through the calculator. But all it does is it juices and increases the return of our capital investors. So the bottom line is your money is out there. It earned money for 6 months. However, you only had it out there for 4 in this example. So it can do two things. It can give protection, make sure the juice is worth the squeeze, so to speak, um, and also make sure that at the same time the borrower that wanted the money, he needed it and he wanted to move on to another deal. It's basically a cost of doing business, and he builds that into his margins and things like that. So.
Amazing. Now, Reed, tell me, are there any, I saw single family properties, multifamily land. Are there any types of properties you would not get into deals with?
Not really big on office right now. So that's part of the market. Yeah, we just don't spend a lot of time in. We don't see a lot of those types of deals come up
Hmm.
anyway. We like mixed use, but
Okay.
generally it would be, yeah, 1 to 4 unit, condos, duplexes, triplexes, quads, multifamily, which is 5 units on up,
Hmm.
land. We do ground up construction. Um, and then we call it small balance commercial lending. So true commercial properties like mixed use, maybe some warehouse, some light industrial, um, things like that. So
Perfect. Now, I'm sure we're going to have some Q&As, but before we move on to the Q&As, let's talk about how can investors invest with Mize Investment Group, especially after seeing these case studies.
sure. Yeah, pretty much you just reach out to me, give me a call. I think my email is on one of the slides here. It's reed@myerscapital.com. You can also just go to our website, passivereturn.com. I don't know if you want to show that slide.
Oh,
And usually we start with just, a suitability call. It's just very light. We just get to know each other. If we don't already know each other, I know some of our viewers here, I have relationships with already, so it's great to see them show up. Um, but yeah, we get to understand who you are, your background, what's your investment, you know, basically like your thesis is. What are you looking for as an investor? And then, you'll have questions for me and I'll have questions for you. And it's kind of like dating. We have a conversation or two, see how it goes. And if things go well, then we continue the conversation.
any final remarks from you, Reed?
No, I really appreciate everybody's time. I don't do too many of these webinars, so I hope everybody found it useful. I'd like to start doing some more. Usually I do a lot of just my meetings, just one-on-one, face-to-face on the phone, but this is a good way to reach a bigger audience, and I hope everybody found it valuable. Feel free to reach out to me personally. I love, spending time getting to know my investors and borrowers, and it's a relationship business, and it sounds cliche, but a lot of people that invest with us are old, longtime clients. I've helped them throughout their real estate, helped them with their family real estate over the years. So if I can meet any of you great folks and I can help you in any way, I certainly will.